Imagine a mutual fund that lets you trade in derivatives, lets you do short selling, and also build structured investment products, all while staying tax efficient. It sounds like it's a hedge fund, right? But no, this is a new specialized investment fund, SIF, introduced by SEBI, and it is shaking up the world of high net worth investing. In today's video, we will do a deep dive on SIFs and answer the most common questions, and will help you to decide whether this high risk, high reward product is a good one for you or not. So first things first, what is an SIF? SIF stands for Specialized Investment Fund, which is a new category of mutual funds created by SEBI for high net worth investors who are comfortable with taking more risk in their investing. Unlike traditional mutual funds, these funds are allowed to take on higher derivative exposure and do short selling and offer structured investment strategies. The minimum investment to invest in this fund would be 10 lakh rupees, which makes it a premium product for the sophisticated investor. So how are SIF different from normal mutual funds, and should you consider them? These are the three biggest differences that we have. First is limited withdrawal. In your normal mutual fund, you have daily withdrawal. However, in SIFs, there can be limited withdrawal. Depending on the product and depending on the scheme, the AMCs may offer daily or weekly or monthly or quarterly or even annual withdrawals. The second point is about derivative trading and short selling. SIFs can short stocks, which means they can have naked positions on short selling, and they can take derivative positions, which a normal mutual fund cannot do. They can take naked positions up to 25% of their corpus. The third difference is about taxation benefits. In category 3 alternate investment funds, which offer the same type of investing strategy, they are taxed at 39%, which is a very high tax slab. However, SIFs will follow the same strategy but will offer the taxation of a mutual fund, which makes it a very highly efficient product in terms of taxation. Since taxation is going to play such a crucial role in deciding whether to invest or not, how are SIFs going to be taxed? SIFs will follow the same tax structure which is applicable for mutual funds, which means that if the SIF has 65% or more in equity, short-term capital gains will be taxed at 20% and long-term capital gains will be taxed at 12.5%. If the SIF holds 35 to 65% in equity, then you will pay slab rates if it is redeemed within 2 years. And after 2 years, it will again be considered as long-term capital gain, so it will be 12.5%. If the SIF is a debt-heavy product, that means it is investing more than 65% in debt products, then all their profits will be taxed at your existing slab rates. This structure of taxation makes them significantly more tax efficient than category 3 AIFs, which face 39% taxation on their trading income. By the way, if you are 40 and above and you haven't planned for your retirement till now and you're confused about financial freedom, then please comment financial freedom in the comment section below. And I'll send you a free video tutorial which will help you to manage your money and build a roadmap for financial freedom. You can also book a call with me, which will be a 60-minute breakthrough strategy call in which we will analyze your current situation and try to build a roadmap for your financial freedom. So with all these features that the SIF is offering, will it replace AIF or PMS? It looks like it will definitely prove to be a great threat to the category 3 AIFs because, like we said, it offers similar investment strategies in a more tax efficient manner. However, it does not seem likely that it will replace the PMS because PMS funds are typically long only funds and they are highly concentrated funds. While SIFs, they have to follow the diversification rules which are applicable for mutual funds, which means that they cannot put more than 10% in a single company. However, PMS does not have any such kind of a restriction. So it is possible that SIFs may steal some market share from the AIFs, but it is not likely to replace PMS. There are broadly 3 categories in SIFs. The first one is equity SIFs, which means they can invest in large caps, mid caps, small caps, and also take derivative exposure. Then there is debt SIF, which means they are investing in debt instruments across duration, and they will hedge against rising interest rates by taking exposure in interest rate futures and options. Then there are hybrid SIFs, which means it will have a mix of debt and equity and real estate, which means they can invest in REITs and InvITs. And they can also offer structured strategies and offer market neutral approaches. Can SIFs use leverage? Yes. Since SEBI has allowed SIFs to invest up to 30% of their corpus in options, there it will be a leveraged product. The futures long and the future short and the option short position will be calculated according to the notional value of the contract. However, in the options buy position, it will be calculated according to the premium paid. Let's come to the big question. Should you invest in SIFs or not? For most retail investors, a simple flexi-cap fund or a hybrid fund would be good enough. But for high net worth investors who are willing to take on higher risks and willing to take on a more aggressive stance in their investing, they could consider SIFs. Those investors who are already investing in AIFs and they are looking for a more tax efficient way to get exposure to the derivatives, they can also definitely look at SIFs. Those people who want to invest in structured products or absolute return strategies, they can have SIFs in their portfolio. However, if you don't understand derivatives and you don't understand short selling and you don't understand the risk behind these strategies, it is better for you to avoid SIFs. The SIFs are going to be a game changer for the sophisticated investors. They're going to be introduced from 1st April 2025, and it will be an exciting space to watch what kind of funds are introduced, or how are they structured, and what is their performance, and what is the interest level among the investors to invest in these kind of funds. Thank you for watching this video. See you in the next one.